Hello friends, I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to the 9th episode of Investing Carva, a Mission Smile initiative where we invite investing stalwarts every month and learn from their vast experience in the investing field. Before we begin, I would request everyone to please keep yourself on mute and switch off your video so that we can have a seamless discussion and soak in all the wisdom. You may type in your questions on the chat box. In the end, we have scheduled time for your questions, so let's begin. Today, our guest is Mr. Shriram Subramanian. Shriram is the founder and managing director of InGovern Research Services Private Limited, India's first proxy advisory and corporate governance advisory firm. InGovern advises companies and investors on corporate governance and shareholder activism. Shriram has over 27 years of global capital market experience. Before starting InGovern in 2010, he was at Infosys consulting for over 8 years, heading wealth and asset management, consulting to global investing banks and asset management firms. Prior to Infosys consulting, he worked in Mumbai in equity research and private equity investment banking for 5 years. He has done MBA from ExaMB, so he is my college senior. I went to the same college for my MBA later in my career. Shriram's inputs are sought by regulators like SEBI, MCA, NFRA. He is a speaker at many public forums and conferences and in media, and is widely quoted for his views on corporate governance matters. Thank you so much, Shriram sir, for doing this. I'll keep myself on mute and over to you. We'll have a 60-minute presentation by Mr. Shriram, and then post that we'll have the Q&A. Over to you, sir.
Thank you, Ankit, for firstly having me on the show. And good morning, everyone. It's indeed a pleasure to be here. Though it's a Sunday morning, thanks for the enthusiasm shown in learning or in trying to find out what we do. And let us see what are the issues in corporate India. I guess we have common grounds from that matter. So my presentation in that sense is based on my experience of InGovern over the past 13 years. InGovern was founded in June 2010, so about 13 years now. And so my observations in corporate India from a corporate governance perspective, what are the learnings for us as investors? How should we behave, act? What should we observe? So I think that if that is a takeaway, that would be good. Understanding corporate governance is about understanding who owns the entity, that is the corporate company, the listed company, who controls the entity. Owning is different from controlling, because controlling is driving the strategy, driving the business, ensuring that risk-reward ratios are shared, etc., etc. So this could be actually not necessarily that of owning. Who runs the entity from a day-to-day perspective? Who runs the entity? Sometimes the control is with someone else, whereas the actual running on a day-to-day basis is someone else, and that itself creates a tension. Sometimes that itself leads to a lot of ways in which the company is driven, and the future determines the future of the company. What financial oversight is there? What is the quality of auditors? What is the risk management practices that the company has, etc. These are, I would say, various aspects of corporate governance. Because if suppose the directors themselves are fairly, I would say, pliable, then the promoter is able to exert their influence over the company. Whereas if the directors, especially the independent directors, have a mind of their own, then whatever the promoter does, at least the independent directors safeguard the company against the promoters itself. What other control mechanisms are there? So we will quickly dive into these aspects of it. So the governance structure, as many of you may already know, is usually the board of directors, is the trustees, driving the company, we'll see various aspects or various quality or the categories of directors, and there are shareholders. The shareholders are obviously the board of directors is supposed to be mandated by shareholders, right, and are supposed to act on behalf of the shareholders. And there are other stakeholders like debt holders. Many companies, especially the highly leveraged companies, the debt holders also become very important stakeholders in that sense from a capital provider perspective, and also can have covenants, etc., which determine how the board acts also, or the company is run to some extent. Of course, in these days where there is a ESG, there are other stakeholders like vendors, employees, etc., which is also coming into the picture, though their exertion or their influence on key decisions which determine, I would say, the economic output of the company may not be so huge. And the board, in turn, has a executive management team which they give directions to. The executive management team, especially supposed to act on the behalf or by the chief executive officer, who could also be a managing director of the company and a member of the board. So one needs to delineate this differentiation itself between who is a managing director and who is a chief executive officer. Chief executive officer belongs to the executive management team, but could also be a managing director and a member of the board of directors. Generally in India, this is sort of not very well understood, but we have in this slide at least made it sort of different to show that the same role, there are two different roles that the same individual may be having. And the accountability goes from the executive management team to the board of directors to the shareholders. The shareholders have to have the right to change the directors, and this happens very often in corporate India. We have many examples, not just the promoter, even from external shareholders who can appoint and remove directors. So that is the power that shareholders have. And obviously the other oversight is provided by auditors, or at least inputs are provided to the board of directors by the auditors, who are supposed to be independent of the executive management team and provide independent oversight for the board of directors. And obviously the board has its own subcommittees, which is the main committee is the audit committee, to which the auditors are supposed to report. Then there is nominations and remuneration committee, risk management committee, investor grievances committee, etc. Some of these committees, like the NRC, which is the nomination audit committee, of course, is a statutory committee. These days, some large companies have ESG committee, etc., etc. So these are subcommittees of the board with specific remit or terms of reference, and then they go deep, and then they in their areas, and then they report back to the board of directors, and likewise. So differentiating between governance and management. What's the board role? Board's role: select, evaluate, and support the CEO, because the board sets, I would say, the tone of the company in a way. The executive management team, of course, executes the strategy, or can come back to the board and say that this is a strategy, and the board in turn approves the strategy. Okay. The management's role is to run the organization in line with the board of directors' directions. In that sense, keep the board educated and informed, seek the board's counsel if required, right? So the board acts like a, I would say, a sounding board for the executive management team. Board's role, again, approve high-level organization goals and policies. This is a very important remit, because what goals and policies are adopted by the company, what is their ESOP policy, what is their remuneration philosophy, how much compensation should be given to the MD or CEO, how much, etc., etc., including the number of people, including probably the gender, I would say, diversity. All these, I would say, high-level thoughts and are articulated and should be the remit of the board, whether they should adopt ESG policies, whether they should, by when they should target net zero. For example, many companies now has targeted by year 2030 will be carbon neutral, etc., etc. And then they give directions to the executive management team to work towards that goal. Obviously, when the board gives direction, say for example, they want to achieve net zero by 2030, the executive management team will come back to them and say, look, we yes, 2030 is achievable, but we have these constraints. We need so much resources, etc., etc. So obviously, resources in terms of people, systems, processes, etc., will be what will be the pushback to the board, and the board will approve a budget or whatever, and then so that's how the interaction between the executive management and the board will happen. Recommend goals and policies. The management, as I told you, will provide the background information and supporting material for the decisions. Right. So the board takes decisions in terms of the strategic vision of the company. Obviously, this is like I would say, many a time point of conflict between, or point of, we shouldn't say conflict, but point of interaction, so to say, between the executive management team and the board. There are moments where it could be completely at diametry 180 degrees. So at one end, the executive management team wants to push the company into some direction, whereas the board is not appreciative of that direction, and then it becomes a point of friction between the executive management and the board itself. Right? Obviously, this, when there is promoter-driven companies, the alignment is much more closer, whereas when there is no promoter-driven companies, the alignment is slightly, I would say, diverse. And this is more visible in terms of, for example, in PSUs, public sector companies, where the executive management team may have some vision, but the board, which largely comprises of bureaucrats or totally, I would say, not business people, they could have different, I would say, outlook. So from that perspective, their, I would say, their vision for the company, their goals for the company are completely different from what the executive management team has in place. Oversee management and organization performance. These days, not only the organization performance is become important, even the board evaluation, that is, the board's performance itself, has become important. And this is something that has been mandated now. Increasingly, companies are putting out to shareholders on what the performance of the board itself is, what action plan did the board set out, and whether they achieved those action plans, etc., etc. So these are things, what worked for the board, what didn't work for the board, and whether they could remedy some of these, whether the board should invest or learn more about technology, whether, etc., etc. So these are things that the board itself becomes sort of holds a mirror to itself, and then puts it out to shareholders for shareholders' information. So again, many time the board members act as advocates in public policy, fundraising, stakeholder and community relations, etc., etc. So obviously, this depends on individual personalities, on how they divide responsibilities in the board, etc. The board of directors of Reliance, this is as of yesterday only. So if you see, there are Mr. Mukesh D. Ambani is the chairman and managing director. In fact, India recently, last year, had a proposal to separate the role of the chairman and managing director. That is, you cannot be one person having both the titles, chairman and managing director. This itself, this is a very, I would say, would have been a groundbreaking, I would say, regulation. Had it been implemented, there was a lot of pushback from corporate India Then subsequently, SEBI had deferred it from 2021 to 2022, but at the last minute, SEBI pulled it out. This was supposed to be effective from April 1st, 2022, but SEBI at the last minute, due to pressure from corporate India, pulled out that regulation. Because even a large company like Reliance Industries has still the same individual. And not only that, in India, it was not just two roles, two people having different roles. That is, one person being a chairman and chairperson, and the other person being managing director. But these two individuals could not even be related to one another. That was the next stipulation, which obviously meant that many promoter-driven owned companies were very, very unhappy with this regulation, and they really worked hard against this regulation and lobbied hard with SEBI. But if you see the types of directors here, one is the chairman and managing director, who's an executive role. Nita M. Ambani is a non-executive, non-independent. So we need to understand these terms. Nita Ambani is not an executive role in the company, but is not an independent director. Nita Ambani came on board because corporate India, again through a SEBI mandated regulation, said that there has to be one woman director on the board. Globally, this gender representation on, I would say, gender diversity on the board has been, I would say, a topic of discussion for the last 10-15 years. But India is probably one of the few countries in the world which has a mandated regulation that there should be a woman director on the board. Initially, India mandated that there should be a woman director on the board, but in 2017, the Kotak Committee recommendations made it all the more important, because most boards started then bringing on family members as women directors. That didn't achieve its objective. So then the Kotak Committee recommended that there should be a woman independent director. So that's the reason you will see that there is there is not just one woman director on the board. There is one more woman director, Arundhati Bhattacharya, as an independent director on the board of Reliance Industries. So this meant that India is slightly ahead in terms of, I would say, some of these regulations. Though I was against these regulatorily mandated gender diversity, but probably that's the need of the hour. We don't know. Then there are executive directors. You will see that Reliance has 4 executive directors. So these are executives, full-time employees of the company. What we observe, or what we should say, know that these individuals are supposed, the executive directors are supposed to devote 100% of their time to the company, right? They are on the payrolls of the company. The company is to compensate them and remunerate them for their services on a full-time basis to the company. So that is the role of the executive directors. Then there are independent directors. So here we have 7 independent directors, right? So you count the number, there are 7 independent directors. So the Indian regulation mandates that if the chairman the chairman of the board is a non-independent director, then the board should comprise of at least 50% independent directors. But if the chairman is an independent director, then the board can comprise of 1/3 independent directors. That's it. So in this case of Reliance, because the chairman is a non-independent director, that is the chairperson, Mukesh Ambani, is a non-independent director. So it has to comprise of at least 50% independent directors. So if you see, that metric is obviously met by Reliance. And this becomes very important. Companies track it very closely, because otherwise they will be non-compliant with the SEBI LODR regulations. We'll move to the next slide, which is Board of Directors of Infosys. Now that you've learned what happens in Reliance, the same way the composition of the board, so to say. Here, Salil Parekh is the managing director of the company, executive director. Okay, but the chairperson here is not an executive director. In the case of Reliance, Mukesh Ambani was an executive director. Mukesh Ambani is paid a compensation and is a executive director. In the case of Infosys, Nandan Nilekani, though a co-founder is not a recognized, I would say, legal term in the Indian Companies Act. So that should be ignored. But the chairman or chairperson of the board, Nandan Nilekani, but he is a non-executive, non-independent director on the board and the chairperson of the board. Salil Parekh is an executive director and managing director of the company. And then Infosys has, if you see, how many independent directors? 6 independent directors. Okay. There is, but Infosys has one term called lead independent director. Okay. And so out of the 6, one of the independent directors is designated as lead independent director. A lead independent director is again a term which is not recognized in Indian corporate law by itself. No, actually, it later SEBI has sort of said that it would be good that there is a lead independent director, but the lead independent has the powers to call a meeting of the board. But so if you see in the case of Reliance, so that there is no lead independent director. Okay, so you need to appreciate that many Indian companies are just going through this journey still. I mean, even the large companies many a time don't understand what is the role of a lead independent director. What is the need for a lead independent director? Because, for example, if the chairperson of the board doesn't call a meeting of that board of directors, especially when the company is in some trouble or when the company is going through a bad phase, etc. When everything is hunky-dory, right, then there is no issue. But when things go bad, that's when the test of the capabilities and the need for action by various directors come into the picture, right? So the need for a lead independent director becomes important at that time. So if the chairperson of the board doesn't call for a meeting, the lead independent director can call for a meeting. Also now, SEBI's regulation tells that there should be one meeting, at least one meeting a year of only the independent directors. Okay. Initially in India, there were many companies which were not allowing the independent directors to interact amongst each other at all. Okay. That means that I have even heard stories that some of these companies would ensure that 2 independent directors do not meet each other. Okay, they would pick up independent directors from the airport and then curate their journey such that the 2 independent directors are never meeting each other. Okay, even during board meetings, etc., etc. So that sort of is a paranoia of some promoters. But now SEBI has mandated that independent directors should meet at least once a year. Some companies, which are the evolved companies like Reliance, Infosys, and all, actually make it a practice now that even every quarter, when the quarterly results are there, there's also a meeting of only the independent directors. Probably an hour or 2 hours is spent just by the independent directors meeting amongst one another, and that's where the lead independent director takes the, I would say, the leadership role of that meeting and then conveys the inputs of all the independent directors to the either the managing director or the chairman of the board. Okay, basically the meeting of the independent directors becomes important to convey their thoughts on a no-name basis to the chairperson or the executive management of the board, right? For example, in the case of Reliance Industries, one of the issues that the independent directors have had, and this is straight from the horse's mouth that I have had interactions with some of the independent directors here, whose names you see on the screen here, that one of their concerns was succession planning of the company, given that Reliance Industries itself has had a bad example of succession planning in that sense, where 2 brothers fought and this one. So the future of the company should not be hostage to such a this one. So there has to be the independent directors themselves have discussed and conveyed to the chairperson that the succession planning has to be very structured and it has to be done over a period of time. And I think Reliance has set out on that journey. It's going to be, I would think, amicable and hopefully not a conflict situation in terms of succession planning and the way assets are divided or whatever amongst the siblings, so to say. Right. So based on those two, you will see that there's the employment taxes and then there's the independent taxes. Here, this is very easy to appreciate. So there is no, this question mark means there is no independent director who is in employment, right? I mean, there is, independent directors get usually a sitting fee of 25,000 rupees, 30,000 rupees, etc. Per board meeting, plus they get commissions. Today, if you see the independent director on Reliance or Infosys and all, get about 2 crores of commissions a year. Okay, that is a type of compensation. But of course, the executive director Salil Parekh, for example, his compensation as MD of Infosys is probably one of the highest in India, corporate India, about 80 crores a year, including ESOPs and all. So this is a non-executive director. Nita Ambani, for example, Nandan Nilekani, for example, is a non-executive director, but he's a non-independent director. And there's an independent director who is independent. Then there's an executive director. Executive director is, of course, non-independent and a full-time employee. Okay. So this should be a balance in the board. So generally, the managing director is fully employed and non-independent. There could be non-executive directors on the board who are non-independent. Sometimes you don't see them, but independent directors, of course, are not in the employment and are supposed to be fully independent. This is again how to qualify fully independent. There was a practice of some of the companies to appoint, I would say, partners of law firms who were providing services to the company itself as independent directors. Okay, so this was a practice that we frowned upon. How could you appoint a partner of the law firm that you are engaging on your board as an independent director? Okay, that person and that law firm is drawing the remuneration from your company. How does that person become independent? This is something that we frown upon. Of course, there were in India independent directors who had been on the board for 30, 40 years. We used to say that the directors on the board have more presence than the furniture in the boardroom. So this is a tenure of director. These are some parameters that we look at when we comment on independent directors and their actually true independence, so to say. Because sometimes if their tenure is more than 10 years, now we say, even SEBI's guidelines and Companies Act guidelines say that there can be 2 terms of 5 years each. But of course, these guidelines said that there is no grandfathering. That is, if somebody had been there before 2014, when the new Companies Act came, that was not counted. Whereas as proxy advisory firms, we were saying, no, that should be counted too, because the spirit of independence is that a person should not be on the board for more than 10 years. Then, of course, there was the question of attendance. If suppose a director is on the board and if they attend no meetings, why are we as shareholders appointing them on the board? And in fact, we could see that there were situations where Nusli Wadia was considered an independent director on the board of Tata Steel and used to attend 0 meetings. 0 meetings in a year, and he was considered independent and he would come up for reappointment. This was the days 10 years ago, 15 years ago, when just being on the board was just a calling card. You know, the shareholders didn't care who was on the board. They just companies used to put out just that these are the prominent individuals on the board. Whether the individuals attended the board meetings or not didn't matter, etc., etc. That regime has changed. Now, in fact, we as proxy advisory firms, we vote against any director who doesn't attend at least 75% board meeting, because that is the attendance. If you and I in college or school used to be thrown out of class or not promoted to the next year because of our attendance, why should we allow these directors to be on the board if they are not attending board meetings, right? And that is not done. So at least 75% of board meetings. Initially, companies used to crib that, look, for a director to come and attend meetings, they have to fly to a city, they have to then, so that is 1 day, attend the board meeting 2 days, go back 3 days, so they have to come in 3 days. Sometimes that is not possible, etc. But in these days of video conferencing, etc., all these are large companies. Don't they have that technology to just attend an hour or two? Then what is the point of attending? If the director is not able to spare 1 or 2 hours, then we as shareholders should be very conscious about that. And that's where attendance has become very, very important. And that is a disclosure that companies make, and shareholders or now proxy advisory firms track that very closely. So as we said, attendance on board meetings, committee meetings, tenure is the number of years on the board. These are tracked very closely to determine the independent director. In fact, going back here, if you see one of the issues recently we raised with Infosys, and this was a discussion with this Govind Iyer, for example. Govind Iyer was a ex-partner of Egon Zehnder. Okay? And Infosys had sought services from Egon Zehnder. So we said that that is a disclosure that you have had to make very, I would say, upfront. And so this Infosys had not made very clear, though they have said he is a partner of Egon Zehnder and former partner, but they have not made very clear that Infosys had availed of services from Egon Zehnder. So this is a slightly tricky thing. How do you consider Govind Iyer as an independent director, especially if they are continuing to avail services from Egon Zehnder? Luckily, Infosys One is not only availed the services of what is known as board evaluation services from Egon Zehnder about 2 years ago or 3 years ago, and it's not a continuing relationship with Egon Zehnder. But of course, that doesn't prevent them from seeking inputs. And two is Govind Iyer has resigned or quit Egon Zehnder. So to that extent, it's a formal relationship, or he was a member of Egon Zehnder previously. But this is something that we need to, as shareholders, keep pushing back to companies. Look, you need to be careful, tax, especially in terms of disclosure, especially in terms of appointing. So if Infosys, for example, had appointed a law firm, partner of a law firm, many companies do that, I mean, even to this day, many large companies, partner of a law firm is appointed as a independent director, and they are availing the services from the law firm. Will say that that person is non-independent. Though the Companies Act talks about what is known as materiality. Materiality is at least, of course, you cannot say buy toothpaste or buy a small service from that company, 1,000 rupees, some relationship exists, etc. So 10% of the revenue should come from, etc., is there. But yet it's a close, continuous relationship. That's what matters. Okay, again, now let's look at who are the shareholders. These are the nature of shareholders now. Of course, you guys know this. So this becomes important because the outlook of each of the shareholders is different. Their holding periods could be different. And many of these also determine what proposals are placed in front of shareholders, and how some of these shareholders vote differently also at proposals which are placed in front of shareholders. Because that's where, if you see why did ESG come into the picture, right? I mean, ESG came because in continental Europe, the pension funds, which usually have a horizon or investment holding period of 30, 40 years, etc. These are pension funds. So they have very long holding periods. They want to ensure that companies really sustain that long. They don't want to keep churning their portfolio. They are fine with 6%, 7%, 8% returns as long as their capital is protected. They don't care whether they achieve 20% IRR, etc. They are there to protect the capital. They are there to fund the pensions when it becomes due 30 years down the line. So these pension funds are very, very, I would say, conscious that the capital doesn't evaporate. They don't take very high risks. And so they want to ensure that the sustainability or the continuity of the companies they invest in. And to that extent, they made it imperative for companies to, I would say, disclose or look at alternatives or etc. And one of the first companies to take this into account was Shell when in the 1970s. Shell Corporation, which is a Netherlands company, okay, it's a Dutch company. When there was this oil scare, all the funds wondered as to what is the future of Shell, because at the end of the day, Shell is an oil company, and when oil is disappearing of the world, probably Shell will not exist after 30 years. So then why are we investing in Shell? And then that forced Shell to look at scenario planning, and that was what is known as the evolution of scenario planning. And that is what puts pressure on companies, right, to adopt. So continental Europe was the first this one. So if you look at one of the what I call the sovereign wealth funds, there is this Norges Bank Investment Management. Once I had visited as part of Infosys consulting there. So Norges Bank Investment Management is a sovereign wealth fund of Norway. What does Norway do? Where is the assets or wealth of Norway? Norway's wealth is the oil of the of the Atlantic of the coast of Norway. So what Norway does is, how does it secure its future using these oil assets? Because right now what happens, of course Norway is very conscious that someday in future this oil will go away, and then we will be, our citizens, our people will be left with no future and no assets, because this oil will run out. So what they have done, they have consciously they impose high taxes. Norway is probably one of the, as you know, even other Scandinavian countries have very high taxes, though education, healthcare and all is sort of near free to its citizens, but they impose very high taxes. And these taxes, they invest in assets around the world. Okay, so they are converting these oil assets to fund assets around the world, and in a diversified manner they are creating wealth for their citizens. So basically they are converting oil assets or current oil assets to future, I would say, wealth for their in a diversified basis, right? And that's where, if you see, these sovereign wealth funds are usually set up in small countries. So Singapore, these Gulf countries, Norway, or all these small countries have sovereign wealth funds. None of the large countries have a sovereign wealth fund. You don't have an India sovereign wealth fund and that kind of a thing, because we are firstly not so much focused, but yeah. Okay, why corporate governance? Again, from a shareholder perspective, we need to look at what motivates, what is the ambition. So this becomes, I would say, the circumstances at which the company is in, right? What is the ambition of the promoter, the executive management team, etc. Avarice is greed. Sometimes short-term greed drives companies and the promoters or the executive management team. And so this is a motivation, especially you will see with very aggressive professional CEOs also. They have to be, I mean, they are sometimes driven by greed. So to that extent, I mean, the independent directors or the directors need to think whether they need to hold back some of the ambitions of the company, right? I mean, this was a discussion that I had with the chairperson of GMR, for example. GMR Group, I said, why did, I mean, good assets, etc. But you as a chairperson, what did you do? I mean, there was no risk management in the company. I mean, at the end of the day, the absolute ambition of the promoter is sort of not held back in or held in check. Risk management is what? Why do we have a brake in our cars, for example? That is In fact, brake is not to stop the car. It is to ensure that we can go faster, but in a very manner that we know that we have a brake and we can hold back whenever we want to, right? Actually, a brake allows us to go as fast as we can in a very controlled manner. That's what risk management is. I think that's where the board members missed out, that holding back the promoters. Apathy, of course, this is very, very predominant in one class of companies. I'm sure you guys can think of the class of companies. I'll discuss that in the next slide. But think about it. Which class of companies displays total apathy to the concerns of shareholders or to shareholder return? That is very clear, right? That is very easy to figure out also. So safeguarding interests of minority shareholders, I would say this is the amalgam, or these are the various, I would say, categories of stakeholders which safeguard the interests. At one end, there is independent actors which are on the board, who are sort of have a responsibility towards minority shareholders, and of course need to ensure that that the promoter actions are at least not against the interests of minority shareholders. Next is the institutional investors. Increasingly now, institutional investors are voting, and this SEBI, thanks to SEBI, now IRDA, etc., they have Indian corporates have had to adopt, Indian institutional investors have had to adopt, I would say, stewardship code. They are supposed to act on behalf of their unit holders, not on behalf of their investee companies. So domestic mutual funds, when we started in 2010, they did not even vote. And subsequently, when SEBI kept on pushing them to vote, they were voting almost 80%, 85% of this one were abstain. They would abstain from voting. So there is for, against, and abstain. So they would abstain from voting. Now SEBI has made it mandatory that there is no concept of abstain. You as domestic mutual funds need to either vote for or against. There is no abstain. So this has put more pressure on domestic mutual funds to go and vote for all the proposals that are placed in front of shareholders. And that means that the institutional investors have to start thinking on each of the proposals that comes their way. And that is the role that the proxy advisory firms make in terms of, I would say, recommending to institutional investors on how they should vote. Okay. The regulators, of course, SEBI, IRDA, PFRDA, etc., various regulators, but they also, of course, have pushed, brought in new regulations, continuous changes of regulations to ensure that the interests of minority shareholders are protected. In fact, just 2 weeks ago, again, SEBI has come out with a slew of changes which protect the interests of minority shareholders. And of course, the environment is dynamic, so regulators also need to be very dynamic. New age companies, Paytm, Zomatos of the world, etc., etc. How do you safeguard the interests of minority shareholders? What should the regulators also consider? They keep thinking about it, and they need to arrive at solution. This keeps happening because in new age companies, what is the concern? The concern is there is no concept of promoter. Many of these companies are promoterless. Two is the founders of the company, in that sense, the MD of the company have only 2%, 5% shares. Okay, today Vijay Shekhar Sharma of Paytm has only 9.9% or so shares. Dipinder Goyal of Zomato has some 5% or 4% shares. The bulk of the shares is held by the private equity firms which funded these companies, and so their motivations are completely different. And so we need to, as minority shareholders or institutional investors, look at it from a different lens. Regulators also have their this one of challenges to address there. So these are the corporate governance traits that we see. Different categories have different traits. Government-owned companies, this is the public sector companies. As we saw, apathy, as many of you would have already known, the circle of apathy that we talked about here predominantly belongs to, I would say, government-owned company. these companies don't care or do not so much act in the interest of shareholders, though the biggest shareholder, ironically, happens to be the government itself. But because these companies are not so investor friendly and focused towards creating shareholder wealth, it comes at the cost of wealth of the government itself. Okay, and that's where if you see the PE multiples, the ROEs, etc., of these companies, the public sector companies are woeful, right? In fact, it's sort of almost a disservice to the Indian taxpayer when the government disinvests or comes out with OFFs, offer for sale of even 2%, 5% of companies at PE multiples, which are, I would say, very, very low. And whereas if they really work towards enhancing just the multiples or the way these companies are governed, the valuations of these companies would be much, much higher, and the governments could then sell off part of the shares to fund its own coffers and benefit the taxpayers, right? Promoter-owned companies, these are, of course, promoter-started or promoter-owned companies, Tata's, Birla's, Reliance, Infosys of the world, of course, now a lot of other pharma, Sun Pharma to Dr. Reddy's to everything, promoter-owned companies. These companies also have their own set of challenges, right? At one end, you have related party transactions. Some of these companies have promoters having their own private limited companies or taking cash out from the company in various means. Compensation is an issue. If you look at year after year, we have commented on compensation of companies like Apollo Tires, Sun TV, Apollo Hospitals, etc., where the promoters take compensation which is completely out of the ballpark of any other peer in those sectors or even the professionals that could take. So the promoters take compensation which are completely out of the ballpark, right? And India listed subsidiaries of multinational, we have this notion that these India listed subsidiaries of multinationals or the MNCs listed on Indian stock exchanges are, we treat them as gods. But unfortunately, this is not the case for across all the MNCs listed in India. In fact, to the extent that even the large companies once in a while screw the minority shareholders. And I'll take the names of Siemens, for example, when they, I would say, merged some 100% subsidiary into the India listed company, they did it at valuations which were not, I would say, in line with the listed company's valuation. So they did it, they obviously overvalued their 100% shares and then they got more percentage. On the contrary, when they sold off their medical healthcare division to and moved it to a 100% sub, they did it at valuations which were much, much lower. So these are pushbacks from companies this one. Then there is the issue, I mean, we had, though we have not commented or we have not had this one, a couple of years ago, Novartis. Novartis is a listed Indian company, but Novartis, if you see, is one of the world's largest or probably the largest pharma company, right? But yet the India company is completely in doldrums. The India listed company is completely in doldrums. What is happening? Novartis has another 100% subsidiary in India, probably sharing the same resources. In fact, the MD of the India listed company is also the MD of the other listed company. And as we saw before, the MD or executive director is supposed to devote 100% of time to one company. So that meant, what that meant is shareholders of this listed company are sort of subsidizing the compensation for the unlisted company. And for all we know, we don't know how much of resources is going there to the unlisted company. All the new launches are happening in the unlisted company. New pharma drug launches are happening in the unlisted company, etc. So that's where you will see that a Novartis listed company in India is not held in high regard. There is no institutional shareholding of merit. I think that's a company that is screwed from this perspective. So India listed subsidiary of MNCs has this issue. We'll quickly look into another case of how this happened. Banks, of course, have multiple, again, there are private, public sector banks, private sector banks. Banks are also governed by the RBI, right? I mean, so to that extent, there is RBI, which also puts its own foot. The Banking Regulation Act, in fact, just earlier this week, we had a discussion in the FICCI with the Department of Financial Services Secretary that there should be unification of regulation between RBI and SEBI, because RBI puts its foot down on appointment of directors, on appointment of tenure of directors, etc. So that is something that is slightly this one. Sorry, so new dimensions of corporate governance, these are slowly coming into the picture. We have discussed some of these. Succession planning, of course, is a huge thing in corporate India. At least and that is something to watch out for. Many, especially promoter-driven companies, will have this issue if they don't plan properly. And we have seen this happening across companies. Wherever there is wealth created, there will be conflict within the promoter family, right? I mean, currently, so many other, you can see this happen in Hero Group, this happened in, I would say, Reliance, this happened across companies where there's a promoter family. You can think that it has happened. Sometimes it is not very visible, need not be very apparent to the public, but there is definitely underlying, I would say, this one. The Goenkas also had their division. So all these, they keep dividing assets. Wherever there's wealth, there will be this one between the next generation. Board diversity, we also talked about this. This is increasingly, again, a focus for many of these evolved investors. Compensation is a very hot button topic. As India Inc. Continues to pay, I would say, globally benchmark compensation, these become very important, and it's always a touchy issue. ESOPs, and especially in these new age companies, as I told you, ESOPs, where the shareholding of the founder is only 2-3-4%, so their compensation could be very high. So shareholders need to be conscious of the compensation, and they need to vote in an informed basis. Cross-border governance. This is again, see, today companies like Oyo in their DRHP said that 90% of their revenues is coming from abroad. How do you sort of look at that, especially if it's not audited? So these are something, I would say, becomes very important from a risk management perspective, from what shareholders know. Sustainability reporting, again, ESG is a big thing. Sustainability and integrated reporting, Indian companies are slowly. BRSR is now mandated from April 1st, 2023, which is so companies will report the mandatory BRSR this year. About 1,000 companies are supposed to report BRSR report, which is the business sustainability report this year. So because the ask from of independent directors has increased, so they have started demanding that the companies take up liability insurance. So again, this I would say slowly Indian companies have started to take director and officer. Officer means the executive team, the MD or the CXO liability insurance. And this will be again become, if you look at the West, which is the US and other European companies, the insurance amounts are huge. So what they safeguard against, etc., this will evolve in India and become a very important metric for shareholders to track. Again, stakeholder involvement, which stakeholders are involved, you need to observe. And Occupy Wall Street versus Main Street, this was in a 2008 movement where you saw that employees and others protested. Why are you, I would say, privatizing profit? and socializing losses. This is something of concern in the US. Even now, you would see this happened when these banks went bust. So this will be also important in India going forward. Okay, this slide is slightly involved, but this comes from the book and corporate disclosures by Shankar Jagannathan. There are 40 embezzlement techniques. I think these 40 techniques itself will take a whole exercise, but I just wanted to put it up. This was actually outlined by Chanakya and Arthashastra on what are the techniques to how accounts are fudged, how companies take out money, or may not take out money, but see something like accounting itself. Simple, like what is collected earlier is accounted later. That is, they push out if there is too much money which is happening and now they don't want to show huge profits, they'll push it out to next year or the next quarter. So this is earnings management, which many Indian large companies are very good at also. Okay, so that is still kosher, but of course kosher in that sense, I would say one can, it may not impact shareholders from a, I would say, a longer term perspective, but in other cases, of course, channel stuffing and those kind of things also happen to show higher short term profits or these. These are, of course, from a forensic perspective. You could look at all these 40 embezzlement techniques. We should do a course on forensic for that. Okay. And so, and from a voting perspective, we come to some case studies from a voting perspective. See, this is a storied company again in India, HDFC, on July 30th, 2018. This is again reopened of non-executive directors. Okay. Deepak Parekh, okay, who is a doyen in that sense. See, again, we should not hold individuals to pedestal, but Deepak Parekh got voted 22.64%. Votes were against his appointment. Okay? And Deepak Parekh needed 75% for. This meant that he barely scraped through. This is like in an election, you are winning. The percentage voted for was 77.36, right? Voted for. So he barely scraped through. In fact, Mr. Bansi Mehta and Mr. Bimal Jalan, again, by themselves, reputed individuals. Bansi Mehta, of course, is the partner of a large Bansi Mehta chartered accountant firm and has been on the board of HDFC for like probably 20 years. Bimal Jalan, ex-governor of the RBI, on the board of HDFC. Both of them resigned, but actually, according to us, though HDFC did not reveal the voting percentages, actually they were voted out by shareholders. See, HDFC, you all know that has almost 75% FII holding, and FIIs had voted against these. Bimal Jalan attended 1 out of 6 board meetings that year. And why would shareholders? As I told you, attendance is something that is looked at very, very closely, right? And if you attend 1 class out of 6 classes, you definitely are going to be failed. And that's what happened to Bimal Jalan. This again was a shock to corporate India, how Deepak Parekh himself just scraped through. And this is shocks to corporate India in that sense. It's a good thing that companies become very, I would say, conscious. Other important proposals which again shocked corporate India, and these are some things that were completely voted against. Okay, ratification of compensation paid to the MD in 2018, August 2018. This shareholder proposal was voted against by shareholders. Okay, this meant that a company, Tata Motors, had to claw back the compensation that it had paid to the MD. Okay, this really shocked corporate India. How come a company like Tata Motors was not able to pass the resolution where it had paid compensation to the MD, right? Eicher Motors, July 2021, not so far away. This completely shocked again corporate India. These are Nifty 50 companies. These are not some very small company, right? The MD, Siddharth Lal, who is a promoter, his appointment was voted against. Okay. So basically, he cannot be the MD. He cannot act as the MD. That was how the shareholders voted against him. There was a technicality, and the company had to scramble and then again represent in all these cases. Then talk to investors. They then engage with shareholders, go and convince them. They make changes in the proposal that they're being again and table it to this one. I'll tell you about Eicher slightly. And then July 2022, enhanced limits of investments made and loans given. This proposal was also voted against by shareholders. What is the concern in Britannia? You all know that Britannia is a part of the Vadia Group. Vadia Group has Go Air. Go Air is under trouble. All of us know. So when Britannia enhanced the limits of investment made from 1,500 to 2,200 crores, so all the shareholders will obviously feel that this is to give more loans to Go Air, etc., etc. So Britannia had not given, or in the past they have given loans, but they have clawbacked or they have taken back the loans. But yet the shareholders are concerned. Why is a cash-rich company like Britannia enhancing the limit? Okay, and in fact, when Britannia engaged with us, we had told them that this is something that shareholders will be very worried about. What is the rationale is not very clear. The CFO of Britannia said that, look, because we are generating so much cash that we need to make investments in private investments or make intercorporate deposits, etc. So these are loans. So we will not be giving, we are conscious that we will not give these loans to Go First or Go Air, but these are required just to make the investments of cash that comes into the company. But that was not explained in a very forceful manner to investors. Okay, and investors obviously will have this at the back of their mind that this could be loans. Once you give the powers to the board, this could be loans given to the Go Air, and that's what happened. And the investors voted against this proposal. Okay, in the case of Eicher was a technicality. They combined two proposals. One was reappointment of the MD, and two was payment of compensation to the MD. Both are actually two different sections in the Companies Act. One is section 196. The second is payment of compensation is section 197. As a practice, companies combine both the proposals into one resolution. Okay. But actually, investors were concerned or worried about the compensation being paid to Siddhartha. Especially 2021 was a COVID year. The company had proposed increasing of the commission payable from 1.5% to 3% of the net profits of the company to Siddhartha. So that investors were uncomfortable. Why are you doubling the commission being paid to Siddhartha? Okay. In fact, the company in the revised proposal came and said that, look, we actually will cap it at 1.5%. And in the past also, historically, though we have we have only paid less than 1.5% of the profits as commission to Siddhartha or the MD. So then why take a 3% year? If you have only been paying 1.5%, take 1.5% as the limit. And that's what the company did. They came up with two different proposals. One is as reappointment of MD, two is as compensation, and with now a 1.5% cap. And both the proposals got voted in, right? So these are strategies, or companies also are evolving in their thinking. A company like Eicher did not even think that they will be voted against. It came as a complete blind spot to them. They were shocked when the MD was not reappointed and had to leave his job basically shareholders sacking the MD. Voting, these are the things, right? What is an ordinary resolution which requires more than 50% of voting shareholders? Special resolution is voting means only the shareholders who vote or voted are counted. The number of shares which vote are counted, right? So if you, just like in our general elections, if most of us stay at home, our votes are not counted, and some candidate who gets more than 50% will be voted again, voted for. Majority of minority promoters cannot vote. I mean, this is slightly wrong here. Cannot not vote, no, cannot vote. Okay. Two is vote for, vote against. You guys know this. Shareholding pattern becomes very, very important because the promoters will always vote for the proposals that they are presenting. Number of shares voted becomes very, very important. As we told, if we stay at home as shareholders, if we don't vote, and this is where SEBI has pushed the institutional shareholders to vote. IRA is pushing. PFRDA has also now adopted that the pension funds need to vote. It becomes very, very important that they vote. Okay. Retail investors, of course, usually tend to be less in number, so they don't usually vote. They are divided, etc., etc. Of course, with e-voting, which has come into prominence, it becomes easier to sit at home and vote. And now companies, of course, where there's contentious proposals, have started doing what is known as vote solicitation. They start soliciting votes from the shareholders to vote for the proposals, and this becomes very, very important. Of course, when there are two sets of parties soliciting votes, that becomes all the more important. They aggressively like campaign. They undertake a campaign, go to our shareholders and campaign for the shares. So this recent, in fact, this was disclosed on Saturday only. So if you see, this is again the proposal. If you see resolution number 1 to consider scheme of among Mangal Industry. Mangal Industry is 100% owned by the promoters. Okay. So again, they are merging the Mangal Industries with Amara Batteries. Okay, take care. So if you see the promoters, they have not voted. If you see number of shares held, etc., etc., they have not voted. This is what is known as a promoters don't get to vote. They are like this is a special resolution. You will see this requires 75% votes. Okay. Whether promoter group are interested in the agenda or resolution, yes. Okay, and if you see the shareholding pattern and the number of votes, eventually this resolution itself has been passed. Surprisingly, Nalanda Capital owns 10% of the shares of this company, 9.9%, and it looks like they have voted for the proposal. Okay. Because you can make out from the number of shares, it looks like they voted for the proposal. Okay, trades of an activist shareholder. We'll just discuss these. We'll take a short break. In the meantime, if you have any questions, please put it out in the chat group, and we can discuss those. Just taking a water break. Yes. Yeah.
Everyone, so you can ask your questions. If you have any question, you can probably type it on the chat box, and Mr. Shriram will be back in 2 minutes. I hope you enjoyed the different kind of webinar today. Generally, we call people who have invested for the last generally we have investors presenting, but today we thought that we should have a clear view from someone who has spent a lot of time advising not only investors but also corporates how to look at corporate governance. So Shriram sir is back, so I'll just keep myself on mute.
Okay. Any specific questions? I think Soham has asked a question on what are the traditional, this one. I think, see, obviously, I'm just looking at the chat. Okay. What has historically lost the most shareholder value? This is a very tricky question. So if you look at different groups, SR Group, JP Group, all these groups have lost a lot of wealth, right? I mean, SR Group, I would think, is the most, as a group, they have lost the most shareholder value in Indian context. And in fact, recently I was asked by media as to SR is making some comeback and those kind of things. And I told that I don't think banks and capital providers in India, that is banks and shareholders, will test them with a barge pole. Okay. So at the end of the day, such is the kind of this one about 10 years ago when they used to visit all the mutual funds and all. I heard a few mutual fund managers tell me that look, we don't want to meet the SR group because it's just a waste of time. What is the most common CG floating? Of course, CG is an evolving thing. The most common, I would think, is now no longer in the large companies, but is a related party transaction. How companies take or the promoters take wealth out of the main listed company, right? I mean, they do it very surreptitiously. Sometimes they have a private limited company which is with which they are transacting. So I would say the transfer price or the price at which they supply goods and services is not at probably a cost or this one that is here. So in fact, in some cases which are very, very explicit, 20 crores, 30 crores are given to some Mauritian subsidiary and then return off, etc. We have come across those cases also. Okay, in a 800 or 1,000 crore revenue, if suppose you are taking out 20 crores every year or every once in few years, they give to some subsidiary or something in Mauritius. Okay, then they write it off. You gave money 20 crores to some Mauritian company and you write it off. Yeah. In fact, about 10 years ago or 12 years ago, Dabur made a $30 million acquisition of a Cyprus entity. Okay. Who makes an acquisition in Cyprus? Okay. And it's not even explained what are the financials of the entity, what are the underlying assets, etc., etc. Just a one-line statement is coming as a shareholder stock exchange notification, saying that Dabur has made, the board of directors has approved a $30 million acquisition of an entity in Cyprus. Okay. What do you make out of it? For all you and I know that the entity is completely a promoter entity and the company has just given off 30 million to this Cyprus entity. Right? So, but of course, these days companies have become, because of the pressure by shareholders, because of that fact that people are looking at it very, very closely, how to view promoters who make a biopic movie of their life. See, obviously, that's an ego thing. If they are funding it out of their own money, it's okay. But if they use company money, of course, it's something to frown upon. Most promoters these days will make biopic movies, or some promoters definitely, most promoters are making coffee table books of their own history and their life history, etc., which is okay. And probably, as long as they spend a few lakhs or few, this one, that's okay. Yeah, how can a retailer? This is a very important question. How can a retailer attain the skill to see such issues? I think you need to observe the shareholder meetings, and you'll see these trends emerge. Just like I showed right now, this Amar Raja batteries shareholder meeting. So these are some things that we will observe that, of course, see, just like you and I cannot change our behavior or our qualities overnight, right? I mean, you have some traits, some positives and some negatives. Same way, I have some positives. companies also have this DNA. There is a DNA to the company. They cannot change overnight. So if a promoter is a chore promoter, that promoter will be a chore promoter for, for a long time. Though the company may put out advertisements, this, that, etc., and say that we are the best in the world, etc. For example, Vedanta in the recent past kept on saying ESG, we are number one, AO, etc. They were, I'm sure there is what is known as greenwashing. I mean, they all the metrics that they put out were completely wrong, or at least be wrong. So promoters don't change their, I would say, manners and their this one overnight. So if you follow Twitter, of course, many of you guys will follow Twitter. So you'll see Anil Agarwal of Vedanta putting out all his stories in a long way that you, as a Twitter follower, you'll think like he's the most, I would say, you feel a soft corner for him, right? You should feel pity for him, the way he came up and all those things. But I mean, all said and done, the way they have treated the minority shareholders in the last 10 years, it's a complete this one, right? So quickly again stepping in, traits of an activist is not about having a big stake. Of course, big stakes are there, but in the West, especially, we have seen that small shareholding also matters, and they have been able to bring about change. There are various tactics adopted also. You need to get the support of other shareholders, and these are, of course, like the activist Rian Partners is a very well-known activist shareholder there. Value Act Capital is a San Francisco-based fund which works on the back end. Back end means they don't come publicly on TV like this Hindenburg came, etc., etc. What Value Act did is at least it went and it talked to each of the directors of the company and said that Steve Ballmer, who was the CEO at that time, is not creating value for Microsoft. He needed to be sacked. So in fact, Value Act then actually put pressure on each of the directors, got a board seat, and then that was a change that happened. Steve Ballmer was sacked, Satya Nadella came, and since Satya Nadella has come on as CEO of Microsoft, look at the value that he has created for Microsoft. Sometimes, of course, these are positive changes, sometimes could be negative, like it happened with Cognizant. Again, Elliott wrote a long letter to Cognizant, got the CEO replaced. That has had disastrous consequences on Cognizant itself. You may want to study that Cognizant case and Elliott. One company in Indian market which you consider, in the last slide I have this, where I say that there is no, I'd say there's no one silver bullet, right? I mean, there's no best of the best in that sense, so to say. There is a category of well-run companies, good companies, okay? I would say category which are good in terms of the quality of how they disclose their numbers, there being a good set of shareholders, there being a good set of directors. At least if the MD or this one goes wrong, the directors act as a checkpoint, etc. Be it Infosys, etc. But again, these are what drives and situations that drive the company and the board, right? So Infosys also went through its bad patch of 2013 to 17, 4 years from a corporate governance perspective. Though it is, I would say, still considered one of the best in India from a perspective of all these traits and characteristics in play. But circumstances determine how good a company is, right? And especially in bad times, how the company behaves is what also matters. Okay, other few questions, I'll just take it up. So safeguarding interest, we already saw this. Motivations, demand change, demand better governance and change. This is happening through voting, but in shareholder activism, this is very, very, I would say, upfront. You as shareholder write a letter to companies and bring about that change. Institutional shareholders, of course, having large assets can do it much better. 2, 3, 4% is enough to go start writing and gathering support of other shareholders. Better returns for by identifying this. Also, we'll see in India slowly where inefficient assets, unlocking of value, etc., could become all the more important. Okay. So one needs to know what are the rights of shareholders. Somebody had asked this question as to how retail investors we can equip ourselves. One is by reading on shareholder meetings itself, what proposals are coming for meetings. Two is what are the rights as a shareholder that we have. I think that is still not well understood. When even you and I as shareholders can write, especially these days, emails to the companies directly, okay, and companies are supposed to respond to our emails, okay. So this is there are some shareholders that I know who are very, very vocal about what they feel about companies, but of course these shareholders they write very, I would say, very amateurish emails. I mean, amateurish means you should write a very, I would say, what is the problem that you see, what are the data points that prevent to the problem, and what is the change that you seek. If these are tabled in the email, then directors are willing to consider some of these. But some people come out and just rant against the company, then the company obviously feels that this is just a rant. There is no point in, they will just reply with a, I would say, very casual response or very lawyerish response, so to say, or a rhetorical response. But now, of course, institutional shareholders are getting board seats or pushing for board seats. This happened in Zee, Dish TV, Yes Bank now, etc., etc. So these are, I would say, the extreme examples where investors are pushing for board seats, and increasingly these kind of situations will happen. Okay, file court cases. In India, class action suits are still not seen the light of day. I have a case study here where traits of an activist shareholder is not about only having capital, but activism takes time and effort. Okay, in-depth research to build up a case. As I told you, there has to be an alternative solution. You cannot just say what I see is wrong. You have to say what is the change that you seek, whether it's directors changing or whether it's some change of strategy or some dividend payout or whatever. So there has to be alternative solution which is proposed by the shareholder. Reach out and garner support of other shareholders, right? I mean, otherwise it's not going to work by yourself. You need to reach out to other shareholders, mutual funds, etc., who have to see your point of view and entering activism. In India, hostile takeovers are seen as a negative. In general, though the environment might slowly change, benign lenders don't support hostile takeovers or new shareholders coming in. So lenders have been usually very, very, this one with respect to current management or promoters. Legal hassles, because everything is taken to the court and courts take their own time, and so that becomes very, very, I would say, slow. And this one, or in the case of Future Group, for example, they pushed it to IBC, insolvency and bankruptcy, and that is also taking a lot of time. Regulatory enforcement, even a regulator like SEBI and all throws up its hand and says that we can't do anything, we are not able to do anything, etc. Though they have some powers of search and seizure, etc., but they have not actually utilized these powers in a very effective manner. They are very slow to act, and that enforcement becomes very, very, I would say, not so fast and effective. Case studies. This is a case of a MNC. We had talked about a subsidiary of MNC screwing minority shareholders. So many people think that Maruti Suzuki is an India company. No, Maruti Suzuki is a MNC. You guys as involved and evolved shareholders, you know that Maruti Suzuki is MNC, right? I mean, this is 56.2% held by Suzuki Motor Corporation. So Suzuki Motor Gujarat was a 100% sub set up by Suzuki Motor. I mean, this is a new company set up, and the land was allotted to MSIL. Okay, this is in around 2014-15. What these people did, they entered into a lease agreement. So Suzuki Motors Gujarat SMG leased the land from MSIL, and Suzuki Motors Gujarat will produce the vehicles and sell it to MSIL for distribution in India. Okay. The only problem is, are you creating value here in Suzuki Motor Gujarat and taking away the value as 100% to Suzuki Motor Corporation? This was a concern. Shareholder voted against this proposal. They pushed back, and the company really engaged with all shareholders, went on road shows. RC Bhargava went and met each of the institutional shareholders. They said, no, this is not the case, etc., etc. Will cost even our services, right? MSIL should cost all its services given to SMG, right? Otherwise, they are deputing people or even giving other dealer network data, etc., etc. If they give all those to Suzuki Motors Gujarat, then that is coming at the cost of the public shareholders. Okay. In fact, now if you see, there's a tie-up between Suzuki Motors and Toyota, and Suzuki Motors makes Toyota cars. I don't know whether you guys know that. Actually, if you see many of the models of Toyota and Suzuki, it is almost the same design, same this one, different branding. Okay? Many of you can spot that. If you're auto enthusiasts, you will know that this. And all the Toyota cars are being manufactured by Suzuki Motors Gujarat in Gujarat. Okay, so all the Toyota cars. But in fact, they had promised, Suzuki Motors Gujarat had said that all the 100% cars will be sold to MSIL, and MSIL will distribute the cars. But because of the Toyota tie-up, I think that Suzuki Motors Gujarat is selling the cars to Toyota, and Toyota is the distribution partner. This, I think, has not been looked at very closely by shareholders later. It has not come as a proposal. I'm not sure how aware investors are in this matter. At that time, when this structure was proposed, there was a lot of pushback, but later it has quietened down, and this has not been in the focus. But I suspect that there is something more, and this structure has not been beneficial to public shareholders of MSIL. Okay, this is David versus Goliath. Coal India at one stage, government had 90% shares. The Children's Investment Fund is TCI, it's called. It was a fund based out of London. So TCI had 2% shares. It had picked up in the Coal India divestment. So with only so much percentage, where the public shareholders was 10%, I would say 10%, and government owned 90%. Basically, TCI set up a website. See what TCI did. It engaged with and it went to court also over its functioning, disparaging of coal pricing disparity. Basically, TCI said India should price coal with respect to link its coal pricing with respect to Indian, I would say, international prices. Right now, Coal India just supplies coal at this month. They don't invest in technologies to enhance the quality of coal. If they do some coal washing, the quality will improve and the pricing also will improve. Coal India was sitting on almost $10 billion of cash, which is almost 50,000 crores at that time. Now, of course, it will be much, much higher. They're not declaring dividends or giving out, etc. So TCI had a set of proposals. It engaged with the government. So they created this website. If you see for Coal for India, this is the classic case of an activist shareholder abroad who usually does in the US and all. They create a website. They create, I would say, they engage with the directors. They engage. So if you see, TCI has put out all these letters, etc., etc. But what was the problem in this? One, we have already seen this is a case of apathetic, I would say, shareholder. That is the one. Two is the shareholding pattern also determines with government owning 90% shares. There obviously they cared a hoot for Coal India's proposals, right? If the government held probably lesser shares, there were other shareholders who had, let's say, mutual funds or insurance companies, and Coal India could gather their support and put pressure from other shareholders also, that would have been a different case. But in this case, government held 90% shares. All these became useless, and then subsequently TCI had to sell off its shares, I would think. Okay, Ultramarine Pigments, this is a small company. So this is a very interesting. They had engaged, one of the shareholders had engaged our services. We had in fact put a case in Bombay High Court also on this matter. This was the test of this section 196(3)(a). For the first time, our involvement actually put the focus on this new section in the Companies Act, where more than I would say, if the just for continuance of employment also beyond 70 years, they needed to seek a special resolution and a vote in. And this case went all the way to the Supreme Court and was not entertained. Supreme Court threw it out. The CMD had to step down. So if you see, this was the CMD stepped down from executive role, and the continuance of employment was cut. And then he brought his sister in at that time as a chairman, okay, chairperson on an executive role, vice chairperson and executive. Okay, Alembic Limited, here Unify Capital, a Chennai-based PMS, held large shares. This is a holding company discount. You guys know many holding companies in India trade at 20-30% discount to I mean 80% discount to the imputed value of the shares. So Alembic holds at that time at least 29.2% shares in Alembic Pharma. Unify tried to appoint its own director on the board. It garnered support of 1,000+ shareholders and tried to propose its director on the board. It was not successful because one is what Unify did. It did not. Firstly, see, you need to use all the pressure points. The problem, Unify Capital acted as at almost the last minute at the AGM. They proposed this director. Unless you build this kind of page, go and canvas to other shareholders, engage with other shareholders, put pressure, etc., it's not. It's almost like a campaign, like an election campaign. You need to do it. But Unify Capital, being a PMS, was not so motivated, I would think. But it tried its hand, but it did not canvas. In fact, they reached out. Unify Capital reached out to us just 1 day or 2 days before the AGM, and then they said, "How can you help us? What can we do in 2 days? I mean, we can't do nothing." So, but if they had done it on a much more structured basis, used much more, I would say, many of these tactics that we already discussed, they could probably have been successful. Because yeah, again, you got to see what is the shareholding of the promoter, whether it's a ordinary resolution, special resolution, how to go about it, etc. You need to use all the being a shareholder activist. Okay. So these are some of the things which the company did. So they rejected, etc. So companies will also use, obviously, when there is an attack on the company, they will use their tactics, right? They'll go to court. This will see in the case of PTC. Again, went through this hassle. I would say Florentry is largest. So PTC is an Anath company. I don't know whether you guys know. 4 PSUs own 4% each shares. For NHPC, NTPC, Power Grid, but this 4% shares doesn't even matter. It probably is not even a rounding of error on their balance sheet, right? So PTC India is like a totally, I would say, Anath company with the CMD and the ministry, whoever the bureaucrat is calling all the shots. Okay, the CMD is like his own fiefdom there, etc. And so it becomes like a this. And even last year, all the independent directors. This is a slightly older case study of 2017, but last year also, that is 2022. If you see the news items and everything, all the independent directors resigned from the company. They wrote to the SEBI. They said that SEBI instituted a forensic audit of PTC and PTC Financial Services, more importantly, which is again a issue. So PTC Financial Services and PTC have this issue that both are anath and they are driven by the whims and fancies of the CMD and one or two bureaucrats in the ministry. Okay, Zee Sony, this is a slightly recent case of last year. September 2021 was when Zee was under pressure. Again, we need to look at the shareholding pattern. The promoters of Zee, Subhash Chandra and his family, own only 4.9% because of their, I would say, diversification into infrastructure, etc., etc. They had pledged Zee share, they were under pressure on their infrastructure projects, etc. They had sold off. In fact, they had sold these 19% shares to Invesco in 2016 or 17, some time ago. But in 2021, September, Invesco called for a EGM. And this EGM, any shareholder, Indian corporate law allows any shareholder owning more than 10% shares, okay, to call for a EGM, extraordinary general meeting, to remove the directors of Zee and appoint new directors. Okay, so Invesco proposed its own set of directors. It wanted to remove the directors of Zee. What Zee did within a couple of days of this Invesco calling for that EGM, Zee came out with this announcement that they are merging with Sony India. Okay, where Sony will get the majority shares. So Sony Corp US will own 51%. They will infuse $1.5 billion. Promoters will get reduced. Promoters of Zee, that is, will get reduced to 2% shares. Okay. So in fact, we as InGovern were very, I would say, was supportive of the efforts of Invesco. We had called for the removal of directors of Zee even before this Invesco called this EGM. But the moment that Zee proposed this merger of Sony India, we were supportive of this because this would change the character of the company. No MNC is going to sign a check of $1.5 billion and not be in control. Though Puneet Goenka of Zee was supposed to continue as MD, we said that Puneet Goenka, Sony is this one because Puneet Goenka as an executive and Zee, if you look at Zee's financials, etc., Zee itself is a debt-free company. It generates a lot of cash. It's a debt-free company. But the issues at Zee again relate to all its other group companies and promoter group companies which were in infrastructure sector, etc. And so they had pledged Zee shares for availing loans in the infrastructure companies, and the promoters subsequently sold off those shares and slowly got reduced to A. So then Zee took Invesco. This is a slightly involved thing. Zee took Invesco to on the EGM, went to the Bombay High Court. Initially, Bombay High Court ruled in favor of Zee promoters. Then there was a disclosure made that Invesco had actually brought Reliance in discussion with Zee promoters for Reliance to acquire Zee. Then Reliance sort of denied it in that sense. They said, yes, we did engage in discussions, but then we are now not interested in the asset. Finally, in February or March 2022, Invesco sold its shares in the stock market, and then the merger of Sony with Zee, Sony India as a private limited company with Zee, the listed company, became imminent. Now it was supposed to be effective April 1st, 2023. Slightly NCLT in the last, there are two steps to NCLT. I think that is not yet become effective. So the merger is just, I mean, any day now will happen and become, I would say, Sony India. The name also may change, I would think, in future. Okay, Infosys, we did briefly touch upon this rough phase from June 2013 to August 2017. Narayan Murthy came back as executive chairman. Rohan Murthy, his son, was brought in as executive assistant to Narayan Murthy. A new CEO was appointed, Vishal Sikka, chairman later. This is the next year, that is 2014. Chairman also became Harsh SSI. So when Narayan Murthy came back, that itself was a huge question. What were, in fact, I wrote a 1,200-word article in Economic Times saying that this actually shows that all the investments that Infosys had made on leadership and on succession planning, etc., is completely gone for a toss. Because at the end of the day, why are you not, as a company and a board, not placing faith in your own CXOs, right, or your own board members? So because Narayan Murthy had to come back as executive chairman, and the fact that Rohan Murthy was an executive assistant is supposed to actually aspire for future leadership roles. Supposed to be somebody who has that exposure, who grew with the company. But whereas these people had parachuted somebody from outside as an executive assistant, and this was something that we were against. And of course, the sting of Vishal Sikka with his style of management led to a lot of rifts between board members, the CEO style functioning. The role of founders became very, very important because none of the founders were on the board, but yet they were getting access to information. How come you as non-board members are getting access to information? How how are you influencing the board members? All this became very, very, I would say, very this one for Infosys, tough for Infosys. In fact, this is probably the first time in India where actually the promoters or the founders tried to be outside of the board. There was no representation of promoters on the board. There was a professional CEO, etc. But yet that experiment went for a toss, and finally one of the founders had to come back as a chairman, non-executive chairman, and then a new CEO was appointed. We saw the board profile earlier. So Future Group, this is, you guys know, it's gone for a complete, I would say, muddle. Future Group itself has a history of corporate restructurings and structurings that we have voted against and against and against year after year after year. You never know which asset is going where, what is the, where is the balance sheet. So many group companies, 6 group companies are listed. You don't know which is what. They are not providing services to third parties. They are only in-house, etc., etc. Last year, there was a possibility of a class action suit. In India, the problem is who will fund a class action suit. In fact, the Future Group, unfortunately, you guys are very, very know very well that when Future announced that Reliance is acquiring its 900 stores, more retail investors jumped into this one. We have had emails from investors stating that we thought Reliance is acquiring Future Group. I mean, Reliance was acquiring the assets, in fact, the stores. They were not even paying 1 rupee to the Future Group company. But these retail investors did not read the fine print or did not even understand what the transaction was. Just because they had announced this, they thought that Reliance is acquiring Future Group, and they went and they loaded up on Future Group shares. Somebody, in fact, wrote to me saying that, sir, मैंने 60 lakhs invest किया Future Group में, Reliance ये announcement. अरे यार, ये क्या किया तुमने? Right? I mean, who the hell? If 60 lakhs तुम्हारे पास है तो दे दो, इधर अंकित को दे दो, अंकित को मैनेज करेगा आपका पैसा. इधर इतना रजिस्टर्ड इन्वेस्टमेंट एडवाइजर्स है, आप जाके कुछ भी पढ़ते नहीं हो और जाके ऐसा 60 lakhs इन्वेस्ट कर देते हो. Then finally the company filed for this IBC, insolvency and bankruptcy, in July. SEBI has instituted a forensic audit. In fact, just 1.5 months ago when I met the SEBI, this one. We have written letters to SEBI and etc. In the past 1.5 years. We have been writing this. There should be a forensic audit of all the future group companies. SEBI finally instituted a forensic audit in July 2022, and now they are saying the forensic auditor is not able to make any headway because the company is not cooperating. In fact, the insolvency and professional he also has complained to NCLT that he is not able to get any. The resolution professional is not able to make any headway because he is not getting any information from the company. The company is not cooperating. So basically, they don't have access to even the books of the company, and the company and the group is completely screwed up. So, I mean, SEBI should actually use its search and seizure powers to go after these cases. They are just sitting in their offices and not doing much. Lessons. Somebody asked this question, so let us see. So these are things that you need to see very closely, especially transition in leadership and appointment of new directors. What is the quality of directors, etc. This is something that you should observe very closely, especially if you have large investments. And of course, don't read much more closely into large transactions that are announced, right? For example, this future group was a very pertinent one. I'm sure you guys are much more evolved investors, but shareholding pattern, look at vulnerabilities, right? I mean, so if a promoter owns 75% of the shares, etc., even a special resolution will be easily passed. But if a promoter owns 30%, 40% shares, many of the Tata Group, in fact, Tata Group, Tata Steel at one time, I don't know whether you guys know, at one time was almost vulnerable to a hostile takeover. There were rumors that ArcelorMittal was doing a hostile takeover because Tata Sons had only 26 or 27% shares in Tata Steel, and then Tatas actually have worked very, very proactively to increase their shares in Tata Steel and Tata Motors. So if you see, slowly over a period of time, they have increased their shares 1-2% every year, and now they are in the mid-30s, I would think. So, and the shareholder proposals, etc., which come, the directors that are appointed all become important based on this. That's where you saw Deepak Parekh getting voted out, almost getting voted out, because 75% of shares are held by FIIs, right? In HDFC Bank and all. So you got to observe the shareholding pattern, and based on that, see the vulnerability of the proposals that come. Succession planning, as I told, is a huge, huge issue. Wherever there is a company which is announcing any change in succession or new executive directors, like Amar Raja Batteries last year announced that 2 of their nephews would be executive directors. So that is something, is a change. I mean, you don't know how much of a backseat the current promoter is taking, how much of leadership roles the new people will take, etc. You got to observe these things very carefully. And the biggest lesson is everyone acts in their self-interest. Okay, every individual, there is no holier than thou. Be it Deepak Parekh, be it Narayan Murthy, be it, when situations come, they will act in their self-interest. Okay, there is nobody acting in your interest for the sake of your interest. But all I'm saying is that circumstances determines their actions. So Infosys, for again, so all their actions have to be seen in light of the situation that they are in. Like just last month, you saw that Google had withdrawn even free meals to employees, etc., etc. That is a circumstance. All these years, Google was making lots of money, and they could fund free meals, free movies, everything to employees. But now they are under a situation under a lot of pressure, and so they are all cutting back on a lot of expenses, sacking employees, etc. Because these are the circumstances, and the actions they've cut down even on food, and this one, how much there were commentary that how much will Google hope to save by cutting down on food to employees. But that is a circumstance. It determines their actions. So this is something that you've got to keep in mind. So, and these actions come to us as shareholders in the promo shareholder meetings and the proposals. So you got to, the more you follow the shareholder proposals or the proposals that come for shareholder vote, you will identify the actions of the company. The aspects to study. That's what, as I told you, what are the private limited companies, be it at a holding company level or subsidiary level or promoters owning 100% shares, etc. Where is the promoter spending time and effort? And even Page Industries, for example, 10 years ago, the Genomals used to have, they are just a few kilometers off here in Bangalore, right? They used to have their own 100% subsidiary, I would say, textile factories, held 100% subsidy by this one company, 100% owned by the promoters. Okay, you don't know how much of time and effort and value they are going to create there. Sometimes the promoters then observe that, oh, my main wealth is in Page Industries, so I should just shutter them, etc. Then they close off their private limited company or merge it or do something, right? But sometimes they may continue to hold those 100% entities, and the Jindals, the Birlas, and all these traditional mindset of the companies, they hold this way. In fact, when we were talking there to one Shankar Jagannathan, he was saying that what happened in the late 90s when the likes of Infosys, Wipro and all, Azim Premji was supposed to be the wealthiest Indian because of the stock price of Wipro, because of markup and all. Traditional Indian companies, their mind blew off, They said, Bhaiya, all these days I am taking money out of Indian companies. I don't care about market capitalization. I don't care about my own value of the shares, etc. They were taking money out of the company. Crores and crores of rupees was going out as actual cash, which the promoter was taking. Only later, promoters realized, I would think in the 1990s and 2000s, that actual wealth is in actually having a higher markup. And I think that is what led to a lot of wealth creation for shareholders who were invested in that period of time. Because this was a promoter realization that we should create wealth for ourselves, and the attribution of market capitalization to our ownership is what determines value or wealth for us. It is not the couple of crores that we are taking out of the company every year. These days, I think some of these promoters tend to do both. They take a few crores to fund their lifestyle, and then the remaining they leave it in the company to increase markup. Okay, so what is their motivation to grow wealth? What is their motivation to share wealth? This is something that you guys need to follow. Okay, don't just blindly invest. Look at, as I told you, everyone acts in their self-interest. Promoters also act in their self-interest. So what is their motivation, right? So today, for example, Infosys, the CEO has huge stock options, right? And these stock options are at 1,600, 1,800 rupees per share. So he is under huge, I would say, he is motivated to increase this one. So there is a slight element that one has to be watchful of Infosys from a short-termism perspective now. Okay, this I'm just telling as a cautionary this perspective, not that there is something that's going to happen, but probably, you will need to observe, because much of this compensation now Infosys has a very detailed compensation, I would say, breakdown of its CEO, Salil Parekh, and much of the compensation is actually linked to the stock price, the operating profit of the company, etc. And so these could act as short-term motivations for the CEO of the company, of Infosys. Investor rights, as I told you, look at what are the rights to table proposals. Any shareholder can table proposal. Even if I want one share of Reliance, I can table a proposal. Okay, if I pay 1 lakh rupees, I can table a proposal to appoint Ankit as a director on board of Reliance Industries tomorrow. Seriously. And the board has to put it to vote to all the shareholders, by the way. Okay. It's another matter Whether shareholders will then see this one in thinking that Ankit is the right director, etc. That is the this one to campaign, right? Then that becomes a campaign. I'm the right candidate type. If Ankit then goes on a campaign, or I campaign saying that Ankit is the right person for a director on the board, and if other shareholders think likewise, LIC holding 9%, Mukesh Ambani, for example, if he thinks that yes, Ankit is the right guy to have on the board, obviously that is 55% votes in the bag. Okay, so this is something that you should know. You as a shareholder have a right to propose anything. It will cost you 1 lakh rupees. A shareholder, as we told in the Indian corporate law, a group of shareholders owning more than 10% shares can call for a shareholder meeting. A EGM can be called, and it need not be a single shareholder owning. It can be a collective of shareholders owning more than 10% can call for a shareholder meeting. Again, you got to table proposals. You got to canvass, get the votes for the proposals. You can call for change of directors. You can call for sacking of the CEO. You can call for anything as a investor. Okay, questions? Sort of, I think I'm on time. I have answered many questions, but yeah. Let me see if there are any other questions. Sorry. I hope I'm just seeing if
Thank you so much, Shriram sir, for taking time out and sharing some really good case studies. I have a few questions, but I'll first ask the audience if anyone has any other question. You can just raise your hand. I think Jagdish, you sent me a message that you wanted to ask a question. So I'll just unmute you so that you can ask the question. Just give me. Yeah. So I hope you all enjoyed the session today. Jagdish, I have unmuted you. You may ask your question now.
Ankit, could you able to hear me? Hello? Hello, Ankit?
yeah, tell me the question.
Yeah, could you able to hear me, sir?
Yeah, I can hear you.
Yeah. Thank you very much for the great insight, sir. It was excellent presentation, lot of learnings. Thank you very much, and thank you, Ankit, for organizing this wonderful session. So just have a couple of questions. What is your view on Adani and Hindenburg report? What is your view on that, sir?
So we have a small 3-page commentary on our website. So you can visit InGovern.com and download that 3-page commentary. So that we published on 27th January 2023, which is just 2 days after the Hindenburg report was released, right? So what is our view? I'll just quickly give our view. One, see, Adani's of course grew too fast too soon, right? I mean, so they were at like going berserk, acquiring assets left, right, and center. Were there some questionable practices like routing some, as still now some of the reports are coming that Vinod Adani linked to the Adani, Gautam Adani is a brother, etc., etc. So that is for regulators to research. The Hindenburg report itself did not bring out any new facts into the picture. But what Hindenburg report did is it summarized all the facts and it acted as a last straw on the camel's back. Okay, so valuations wise, this wise, of course, Adani's stock price was a huge price. So there are two aspects to it. One is valuations of Adani stocks. Two is whether there are transactions or questionable shareholdings of the Adani Group. These are two. Irrespective of valuation, you've got to, investigators have to investigate whether the transactions are questionable or this one. Whereas valuation, anybody has a comment on valuation, yes, they are free to, I would say, short shares or buy shares, etc. And valuation is on the eyes of the beholder, right? Immediately thereafter, within a couple of weeks, that GQG partners invested some $2.5 billion or $3 billion, and then they said that we see great value, etc. Definitely, Adani's have achieved many of these assets on the cheap. They have near monopoly characteristic of many of the assets in India, and these are like infrastructure assets, ports, airports, roads, etc. So from that perspective, even a user pricing in Mumbai airport, if suppose tomorrow they increase by 500 rupees, you and I as flyers are screwed, but Adani will make a lot of money. So valuation is a different aspect, and these regulatory infringements are a different aspect. I think one needs to separate these. There was a lot of hue and cry on Hindenburg and short selling and that all those. Whereas actually that was not the crux. The crux of the matter should have been, or the focus should have been on any regulatory infringements, and that should be the remit with which now SEBI is looking into and making representation or giving, I would say, their report to the Supreme Court now, and whatever comes out of it, we'll have to see.
Yeah, thank you, sir. Sir, as an investor, how do we understand the complex financial engineering? Okay, I'm using the word financial engineering, especially Adani Group. Okay, how do we understand that financial engineering? How do we understand the round tripping of money? Correct. And this is one. And the addition to this is, what is your view on the minimum shareholding pattern and allegation against Adani that round tripping of money, his money is invested in his own company, the Mauritius invested. What is your view? Okay, what allegation is different, but what is your view on that?
Yeah, see, there are two things. Your first question you said is how we as retail investors can assess, right?
Yeah, exactly, sir. Yeah.
Okay, so of course, you and I only have access to data and information which is there in the public domain, right? That is one disadvantage that we have. We are not regulators who can go, and I am saying even a regulator who has powers to do search and seizure is not doing it. Okay, even a SEBI is saying that I don't have access to information. I have appointed a forensic auditor, etc. They find it difficult. So how much more difficult it is for you and I to gather or to understand or study this. So to that extent, even the international corporate governance network and all advocates investigative journalism. So we have to be on top of all the journalistic reports. In India, of course, Adani is also supposed to put down or this one on journalistic reports. But yet, if you see over the past 2 years, we as proxy advisory firms, I gathered the data, we had voted against 27% of the proposals that were placed to shareholders. Okay, one. Two is there were articles by Morning Context, Business Standard, Financial Express, etc. against many of these Adani things. So it was casting this one. Three is you and I as investors have to say, there is no smoke without fire. At the end of the day, this is some smoke which is coming. We are not able to determine what is the motivation of the promoters, what is the motivation of the company, whether they will be able to share wealth with other shareholders. I am not able to make an informed judgment. So beyond that, of course, we are our backs are tied to the wall. We can never ever go 100% of the way. So we have to act on the information, as much information as we can gather.
Okay, so last question is now Supreme Court has set up a committee, expert committee to come out with their what do you call result? Whatever the study they do it, and they need to report to the Supreme Court, and also they have given SEBI to investigation come back. Okay, one is that what Supreme Court committee or the expert committee, will they investigate everything what happened Hindenburg, what he has alleged, okay, and is it correct or not? What actually they're expecting Supreme Court from the expert committee, and what they're expecting from the SEBI. Will these two report will give actual fact?
I mean, obviously, yeah, there will be a lot of sugar coating. There is, I mean, I don't expect it to come out as actual fact. Firstly, the terms of reference of the Supreme Court to the committee members. The committee members, if you look at the committee members, all are sort of from corporate India in that sense, KV Kamar, Nandan, Nilakani, etc. So they are not like investigative agencies or people with investigative background or mindset. Only one retired judge is there. So I would, and that too, the terms of reference was something to do with investor protection and those things, which are very, very, I would say, motherhood kind of statements. So I don't expect any, I would say, tangible this one. If anything, there is a lot of pressure on SEBI. They'll put the onus on SEBI. This entire Supreme Court itself is a wrong thing, because SEBI is a regulator, and the Parliament, if anything, should have held SEBI accountable. There was no need for Supreme Court to enter the picture at all, because they are going to the turf of the regulator. And if anything, SEBI should do its job. I mean, SEBI doesn't do its job. Wakes up late. SEBI has its own constraints of capacity and capability. Capacity is the number of people in SEBI and resources and time that they have. Two is capabilities. Many a time they don't have the right capability for especially these advanced forensics kind of things and all. So they tend to rely on third parties for forensic audit and the like. And motivation also, right? Across the world, not just in India. If there's a very motivated, even an individual within the regulator, like SEC has some Kashkari, he'll go behind all the bad elements. And that's when one guy called Kashkari went behind even Rajat Gupta, etc., etc. So you will find a slew of, so that one individual within a regulator who is motivated can make a difference.
Okay, sir. Thank you. Thank you very much for your answer, sir. Thank you very much. Yeah.
So there are a few questions in the chat box. I'll just read one or two of them, which are very important, I guess. Let me just read out to them. So Ravi asks a very interesting question. One company in Indian market who you would consider as the best in corporate governance, which a retail investor can read and learn.
Okay, Ankit. So I have answered that question in the past also, just a few tens of minutes ago. There is no one such company. As I told you, it's categories. So many a time now BSEs and also putting out CRISIL corporate governance report, those kind of reports come up. So you have to think of these companies as categories of companies, right? I mean, so there is the likes of Infosys, TCS, HDFC Bank, etc., which are quite clean in terms of, I would say, the numbers, believable numbers, believable, you don't think that they would screw up from those numbers perspective. There is always some allegations that Infosys tries to do Q on Q massaging to some extent, etc. But those are fine. I mean, so, but of course, as I told you, circumstances also determine different set of circumstances. Their behavior will then change. So you got to also keep monitoring it, right? I mean, even the best of companies, as I told you, will act in self-interest. The CEO suddenly changes, the CEO will act in his or her self-interest. So that you got to see it from that perspective. Okay, what pros and cons are facing because of ESG regulations? See, market facing means companies, I would think you are saying, definitely it's a new thing in corporate India. Corporate India is devoting a lot of time and effort in coming up with or dealing with these ESG regulations. They have to meet, at least from a disclosure perspective, they have to now disclose. But as I told you, many companies were doing what is known as greenwashing. Greenwashing is basically they are disclosing something which is not audited, or rather, you put out metrics that I have saved 10% energy. Okay, then who certifies, or how do you and I as investors know that they really saved 10? So now SEBI has again proposed just last month that there should be audit from next year. So the auditors have to sign off, or some audit has to be done, that the metrics that these companies are disclosing should be, I would say, the correct metrics. So that puts pressure on companies to come up with the right metrics. ESG is an evolving thing; it's new across the world. So obviously, companies are putting a lot of time and effort in adhering. And this will also change some of their practices, right? I mean, because and different industries have different, I would say, ESG regulations in that sense. There is no one set, this one fits all type. In fact, I was talking to a senior executive of a company which said, senior executive means the president and a group CFO of one of the large listed companies. And he was saying, look, I mean, one of the, there was this one on disability, somebody raised that how many of your outlets are disability friendly? And they said, okay, because he had an open mind, he told his employees, they have ESG team, he told his ESG team to look at how many of our offices are disability friendly, and they went ahead and they put ramps and the likes, so many have to be put, etc., etc. But then the external activist kind of a guy, he started threatening the company and demanding that all their outlets be ESG. And this company figured out that they have only one employee. They have 30,000 people in that company. They have one employee who is sort of disabled in that sense. And to meet that person or this one, they have to make so much changes, right? I mean, so you cannot hold, there has to be a business imperative also to this, and there has to be a sense of practicality to it also. They cannot, all their outlets, all their offices across India to make it disability friendly doesn't make sense, because, I mean, they're not going to be hiring employees across. Of course, if they have shops, for example, if this same company were a retail outlet, they have to make all their shops disability friendly. That's a different industry. Whereas, for example, ESG regulation applied to metals and minerals, for example, the commodity companies, the steel factories, and the like will be completely different. Pollution, chemicals, industry will be completely different. There has to be an element of practicality to the demands, because of course a company cannot sacrifice its, I would say, business outlook and at the cost of, I would say, adhering to all ESG regulations. But yet companies are now sensitive to it, let me say, and this will evolve. Both shareholders have to also appreciate the pulls and pressures, and companies also have to appreciate that they need to work and contribute more.
So thank you so much, Shriram sir, for this insightful session. I just have one question. In one of the slides, you mentioned about Amara Raja, where you mentioned that Nalanda had a stake, but they didn't raise any objection. So I was reminded of a similar kind of incident in case of Berkshire Hathaway. I think it's a 10-year-old situation in Coca-Cola, where the Coca-Cola management actually came up with a highly excessive compensation plan, stock equity plan, I guess, where Warren Buffett and Charlie Munger, they were not happy with the plan. However, they abstained from voting because they said that they didn't want it to go as a disapproval of the management. They just didn't like, or they didn't agree with the issue at hand, but they didn't want to vote. So what do you say about something like this? I think with this we can end today's session because I think this is very important.
Again, yes, you have to observe how many of these investors vote for or against or abstain, kind of a thing. If they are showing a dissonance, mutual funds now in India are mandated to disclose how they voted. So if you go to any of the fund houses website on a quarterly basis, there's a disclosure on how they voted at the proposals. So you can see whether they voted negatively against some of the proposals, and they have to also give a rationale of why they voted in one liner. So that in your Berkshire Hathaway case, they would have had to give a reason for why they voted for or against or abstained. In India now, anyway, domestic mutual funds cannot abstain, as I told you. So for against, they have to give a reason for that, and that is why it is important that we as investors, at least as somebody had asked, we can use these. We have to, if especially we are putting more and more efforts in research, these are new data points, new insights that we can develop. Somebody has asked here, can high institutional ownership itself indicate something better governance? I wouldn't say so. See, investors, institutional investors, as in Peter Lynch's book, he has said, institutional investors had 10,000 crores tomorrow. They have to invest 10,000 crores. Okay, they cannot sit on cash. So the moment they have 10,000, they have to go and invest. And because they have to invest in diverse assets, they will go and invest. Today, any of the Indian fund house has 600, 700. When 10 years ago, they had the Birlas and the Reliance. Now Nippon Asset Management, HDFC and all owned only 200 stocks. Today they own 600, 700 stocks. Okay, across all their schemes, if you see, they own 600, 700 stocks. If you think of the investable universe in India is about 1,500 stocks, right? And they almost own a HDFC fund house owns almost half the market. So from that perspective, would you say that just because HDFC owns some stock, that means good governance? No. You now have the next level of data point. How much percentage of the shares do all the schemes own? Probably you can look at that. Two is how are they voting for or against? Because they, at least they have, they can diversify, right? If they own 1% of, say, Amar Raja shares in one of their schemes, that's not going to change their performance. Whereas if you invest a few lakhs of rupees and it's a significant portion of your and our or your client's wealth, that means that it can have a huge impact. So you got to look at that, and the motivation of a HDFC fund manager to your motivation is completely different. Their horizons, investment horizons, all this. So only thing is, some institutional investor ownership means that there is some amount of research coverage, etc., etc. Beyond that, obviously, it's a tricky thing.
Thank you so much, Shriram sir, and this was an excellent session. And in the interest of time, we have to leave it here. But thank you so much for all of you who could join. And thank you once again, Shriram sir, for sharing your rich experience and wisdom with all of us. With this, we come to the end of the presentation. Thank you so much. Okay. Bye, everyone. Have a nice weekend.